Hello investors and traders, and welcome to the weekly market report with the market guys. I'm AJ Monty. This is a 1-year daily candle chart of the power shares, ticker symbol QQQ. The Qs, as they're often referred to, represent the NASDAQ market, and I've left my lines on the chart from last week's report so you can see how well the forecast worked out and how good of a tool technical analysis really is for forecasting. This diagonal line right here was drawn last Friday, and I said that the markets will most likely move higher, and I even explained to the new followers of the market guys, I explained how the end of that line represents the target price, and you can see here Friday the 24th we closed right at my target price, and the market moved up right in line with that forecast line. Now, an interesting thing here, and something that we have to keep in mind for next week, is that we have a full trading week starting on Monday the 27th. And Monday is now known as Cyber Monday. So there's going to be economic data coming from that side of our economy where people will be going online to do some holiday shopping. And so I'm not quite sure what that's going to look like. We'll have to wait to see how the numbers are released. But there is a gap below the market right here. You see, from the 20th of November right up until the 21st, we had a gap. The market moved higher on higher volume, and then we proceeded higher. Now, this is a 3-day consecutive green candle pattern, but you can see here that the volume is dropping as the price is going up. That's number one. That's something you have to pay very close attention to. So there's the gap below the market. There's the stretch of green candles on lower volume. And we have a wide divergence from this 20-period moving average, which is that blue line, to the price. We often call that the rubber band effect. So the rubber band is being stretched here with that gap below the market as volume is dropping. Put that all together, that's fairly bearish. Now, I'm not talking we're going to have a market collapse next week, but I do believe we're going to have a pullback in the market back towards that moving average to fill the gap. So the end of this diagonal line now becomes my target, with the gap fill point being right here, which will most likely act as support. So I'm going to leave all of those lines in place as I've done in the past. You can see these are previous forecast lines where the market has moved right in line with my forecast back then, and I think there's a good shot that the market will move in line with these forecast lines for next week. So that's the Qs. If we look at the Russell 2000, which is a more broad-based index, similar thing had happened. I drew my line, my forecast line here, saying that the Russell 2000 will most likely rally. And I drew this line as a resistance point, saying that that would most likely be a target, but we'll have to see whether or not the market sustains levels over that high resistance point or pull back. My guess is that because of this little shadow above the candle, you see this one, this is spinning top, but this is very much like an inverted hammer where we have a long shadow above that candle telling us that the sellers on this day had pushed it down on the 22nd. So they tried to keep it higher and rally to higher levels, but the sellers came back. We have a red candle, a long shadow. That is often taken as a bearish signal. So I think what we're going to see for next week is just like we saw in the Qs. I think we're going to see a pullback towards this moving average down here. Again, the end of this line being my target price for next week. So that's the Russell 2000. Keep in mind, that's a more broad-based index than the Dow Jones Industrial Average, the Qs, the S&P 500. The Russell 2000 tracks obviously 2,000 stocks. So this pulling back carries a little bit more weight than what we saw in the Qs. Now let's talk about the diamonds. That's ticker symbol DIA. That represents the Dow Jones Industrial Average. And you can see here we gapped up last week on the 21st. We gapped up, and then right after that we had a bearish engulfing pattern. That's bearish. So we did trade up like I said we would, and then we gapped up. But right here, you notice my forecast for last week was that we would pull back after we rallied. And so this bearish engulfing pattern followed by a long shadowed candle, again, that's bearish. So what I'm going to do is I'm simply going to move this line over. I still think we're going to pull back just like I forecasted last week, but I think it's just going to happen really early on in the week. So that's for the diamonds. And you can see here that on Friday we had a lower volume, but remember that was a holiday trading day, so I don't expect that to be anything of any kind of significance. That's just because people took a long holiday weekend. That's all that means. So that volume is not to be misinterpreted. But the bearish engulfing pattern here, followed by the hammer, the inverted hammer here, that is bearish. So I think we're going to pull back for the diamonds. Let's talk about the spiders. That's the S&P 500 ETF. We do see that the market rallied just like I said it would, and then I said we would pull back. This is a doji, and when we see this on decreasing volume, see these volume bars here are significant because it's showing a pattern of volume dropping, and that doji is a sign of indecision, usually found at pivot points. So let me zoom in here so I can continue with my forecast. I'm just going to move this over. Still think we're going to pull back just like I said last week, and this pattern will most likely pull back to the moving average. So again, this is my forecast with the end of that line being my target price. Now finally, let's talk about the VIX. The volatility index is a leading indicator. I did say that we would pull back. We did that with the VIX, and then I said we would most likely drop and bounce. Now, what I did last week is, and I mentioned this, I said I'm drawing the VIX in a 2-week forecast. So I'm going to leave this in exactly the way I drew it last week. And I think that this, again, the pullback point, a pivot point will be right here. And you can see that this long shadow, this is known as the hammer pattern. This is a very bullish pattern. And we're bouncing right off of this key support level right here. So if the VIX is expected to rally, and I think it will, then the S&P is inversely related, so the S&P will most likely drop. This end of the line right there is my forecast for the VIX. Now, if you'd like to learn more about what we do at The Market Guys, just go to The Market Guys website, that's themarketguys.com, and click on the video tab right there. That will bring you to our video library that we call Market Shots. And if you scroll down just a little bit right here, second one on the right, you'll see the rubber band effect is a short video. It's about 7 minutes long that explains how, when you have that price divergence from the moving average, how significant that is for those who trade especially, but how significant it really is for managing risk as well. So hopefully you'll get a lot of value out of that library, and you'll stay connected to The Market Guys. So have a good rest of the weekend, and we'll talk to you next week. So long.
This video segment is a small part of what The Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.